Before silver moves, it goes quiet. And when it goes quiet, history tells you to pay attention. Silver never explodes without first being ignored, misunderstood, and structurally cornered. And right now, silver is being quietly pulled in two opposite directions at the same time. One force is draining it from the physical world, while the other is inflating paper claims on top of it. When those two forces finally collide, the repricing isn't gradual. It's violent. Most people think silver is cheap because nothing is happening on the chart. But history doesn't reward people who wait for confirmation. It rewards people who recognize pressure building beneath the surface. And pressure is exactly what defines the silver market today. A pressure created by inflation, the energy transition, geopolitical instability, and the slow collapse of trust in fiat currency systems. To understand why silver is about to explode, you first have to forget the way it used to behave. The role of silver has fundamentally changed. It's no longer just a monetary metal, and it's no longer just an industrial input. It's both, at the same time. That combination is historically rare and extremely dangerous for price stability. Let's start with the monetary side. Silver and money have been inseparable for thousands of years. Long before paper, before central banks, before interest rates, silver was money. Empires rose on it and collapsed when they debased it. Rome, China, Spain all learned the same lesson. When silver supply becomes constrained while political spending expands, the currency system breaks down. Fast forward to the modern world. The system looks different, but the mechanics are exactly the same. Governments have accumulated levels of debt that can't be serviced honestly. Interest rates were held artificially low for more than a decade, and when inflation finally surfaced, central banks responded too late. Now they're trapped. Raise rates and the debt implodes. Cut rates and currencies implode. History shows which path is always chosen. Inflation isn't gone. It's been absorbed, disguised, and pushed into assets, energy, and necessities. And when inflation becomes structural, hard assets respond first. Gold reacts immediately. Silver follows. But when silver follows, it doesn't creep, it sprints. Now, look at what central banks are doing, not what they say publicly. They're buying gold aggressively, year after year. Not because gold offers returns, but because it's outside the system. It carries no counterparty risk. It can't be frozen, defaulted on, or printed away. And silver historically lags gold early in cycles, and then dramatically overperforms later, because the market for silver is far smaller, thinner, and less liquid. This is where the second force comes in, industrial demand, and this is where silver becomes something entirely different from gold. Gold is stored, silver is consumed, and consumption changes everything. The modern economy is built on electricity, data, and the energy transition. Silver sits at the center of that transformation. It's the most conductive metal on Earth. It's used in solar panels, electric vehicles, advanced electronics, medical devices, military systems, satellites, data centers, and emerging technologies that governments now consider strategic infrastructure. Solar energy alone consumes enormous quantities of silver. Despite headlines about efficiency gains, the total amount of silver used keeps rising because deployment scale overwhelms those improvements. Electric vehicles use multiple times more silver than combustion engines, and every attempt to electrify transportation pushes demand higher. Here's the problem. Unlike oil, copper, or lithium, silver supply can't respond quickly. Most silver production comes as a byproduct of other mining operations. It's not mined because silver prices rise. It's mined because lead, zinc, or copper prices justify a project. This means silver supply is largely price inelastic. Even if silver doubles tomorrow, new supply wouldn't arrive for many years. At the same time, environmental restrictions, permitting delays, capital scarcity, and declining ore grades have made mining more difficult across the world. Major discoveries are rare, and development timelines stretch over a decade. Supply isn't growing, it's stagnating. Now combine that with the fact that silver is consumed. Once it's used in a solar panel or an electronic circuit, it doesn't come back into the market. Recycling rates are limited, costly, and energy intensive. This means above-ground inventories decline year after year, quietly, invisibly, until suddenly they're gone. Most investors don't track inventories, they track price. But price can remain suppressed far longer than supply fundamentals suggest, because paper markets create the illusion of abundance. Futures contracts, ETFs, derivatives, and unallocated accounts multiply claims on the same physical metal. As long as holders don't demand delivery, the system appears stable. History shows what happens when that illusion breaks. The moment too many participants request physical settlement, the market discovers that paper silver far exceeds real silver. At that point, price becomes relevant because availability becomes the real variable. We've seen versions of this before. In the 1970s inflation cycle, silver moved from single digits to nearly $50. Not because of speculation alone, but because inflation, energy shocks, and monetary instability converged in a system that couldn't expand silver supply fast enough. Today, the parallels are even more intense. Energy shocks, geopolitical fragmentation, trade wars, sanctions, and supply chain nationalism are reshaping the global economy. Governments are no longer optimizing for efficiency. They're optimizing for resilience and sovereignty. That means stockpiling strategic materials. Silver is quietly becoming one of those materials. Military applications alone consume it. Guided weapons, communication systems, and advanced electronics all rely on it. Yet unlike oil, there's no publicly disclosed strategic silver reserve. This is where geopolitical risk enters the equation. Resource nationalism, export restrictions, and regional conflicts threaten supply chains. Every disruption tightens the physical market further. The silver market doesn't need a crisis to explode. It only needs the perception of scarcity to shift. Meanwhile, retail investors focus on gold, ignoring silver. Institutions hedge quietly. Industry secures long-term contracts. Governments avoid discussion. And banks continue to trade paper claims as if nothing has changed. But this is how every major repricing begins, invisibly. The final catalyst is trust, or rather the loss of it. Fiat systems rely entirely on confidence. Confidence that money retains value, that deposits are safe, that debt will be honored, and that rules won't change overnight. That confidence has been eroding slowly since the financial crisis, accelerated during the pandemic, and fractured further during sanctions and reserve freezes. When confidence erodes, people don't rush immediately. They hesitate first, they question, they diversify, and then they move. Historically, when people move from paper to physical, silver moves later than gold, but faster and more violently because it's thinner. Silver doesn't need universal adoption. It only needs marginal demand to overwhelm supply because the buffer no longer exists. Above-ground stocks aren't large warehouses waiting to be unlocked. They are actively being consumed. This creates an asymmetric setup. The downside is limited by production costs, scarcity, and industrial demand. The upside is open-ended because price must rise to ration consumption or incentivize substitution, and substitution is limited. This is why silver explosions feel sudden. They aren't new demand, they are delayed recognition. The market today is pricing silver as if it exists in a vacuum, disconnected from inflation, energy policy, geopolitics, and central bank behavior. But history never allows silos to persist indefinitely. Systems eventually converge. When they do, silver becomes the release valve. This isn't about timing charts or predictions. This is about recognizing a structural imbalance before it's reflected in headlines. Silver rarely warns loudly, it whispers first. And the whisper right now is inventory tightening, rising industrial dependence, weakening currencies, and growing distrust. When the narrative finally flips, it won't be gradual. Analysts will scramble, price targets will jump, and narratives will change overnight. People will say no one could have seen it coming. But history shows otherwise. Silver always tells you before it moves. You just have to listen. And right now, silver is telling the same story it has told before every major repricing in history. Pressure is building, quietly, relentlessly. And once it releases, it doesn't ask whether anyone is ready. It never does. Thanks for watching. If you found this valuable, don't forget to like and subscribe for more insights.